Now let me start with some fresh insights. Last week, we received results from a survey we sent out to our portfolio companies about how they perceive nature risk. 48% of the responding companies now consider nature risk to be financially material. That means it could impact their operations or results. And while survey responses, as you know, they're not hard science, this validates our decisions to look further into this risk and combine our climate and nature disclosures into one single document in 2024. But let me be honest, while it conceptually makes sense to treat these topics together, the complexity really became apparent when we wrote these disclosures. We are dealing with different yet interconnected risks and a portfolio of over 8,000 companies. But that's why we organized this event here today, to share insights, foster dialogue, and collectively build knowledge about nature and climate risks. And I'm fortunate to be joined by my colleagues, you can see here, Mia, Christopher, and Julia. Over the next 25 minutes, we will cover how the fund is exposed to climate and nature risks, what our portfolio companies are doing, how they're addressing these risks, and our future priorities. And after our presentation, very excited to welcome Dr. Nicola Ranger from Oxford University and Martin Skanke, the former chair of the expert group on climate risk and the fund, and very looking forward to hearing your perspectives and your questions at the end. Now, turning to you, Mia, let's come back to my initial point about combining our climate and nature disclosures. Could you explain why does that integration make sense from a science perspective?
I can. So climate systems and ecosystems exist in a delicate balance. So we know that climate change threatens biodiversity, but we also know that healthy and adaptive ecosystems help us be more resilient and mitigate climate change. Now, scientists have acknowledged these interconnections for decades. However, among investors, we haven't really quantified these interconnections, and that is something we are actively working on. Now, this is important to us because nature provides critical resources that fuel our economy, right? So think about direct resources such as food, fuel, or medicines, or more regulatory services such as carbon sequestration and flood control. Now, these natural services underpin economic development, but they are rarely valued in financial markets. But for investors, it's about understanding the future risk-reward of our current investments and also potential investment opportunities. Traditional climate scenario models don't really account for the economic impacts it has on natural systems and the future availability of natural resources. For example, I'll give you one example from the fisheries on how climate change have an impact on species and then how the species have an impact on industries, as for example, fisheries. So as the ocean temperature is changing, studies have found that fish stocks move following the preferred temperatures. So when climate change leads to changes in species distribution, the fishermen also need to follow. Addressing these interconnections between climate and species leads to better measurement of future risk. And this is what we are working on in the fund. So now Christopher is going to talk about how we measure this currently on the portfolio.
Thank you, Mia. So there's actually a very interesting story about emissions in the fund. The big picture, as we know, is that global emissions are continuing to go up. And this means a warmer world, a more volatile world, and this is a big risk to the fund in the long term. So this worries us. If you look at the blue line on this chart, it shows the emissions associated with listed markets globally. And they have gone up, as I said. Now, the fund's benchmark makes some adjustments to this index. Particularly, we remove ethical exclusions related to coal. And the removal of these companies contribute to lowering the emissions of the benchmark relative to the index. And that is done at the ministry level. The fund does not have a separate decarbonization target. This was one of the recommendations that Martin made 3 years ago when he put forward his report with recommendations on how climate risk should be managed in the fund, and this recommendation was accepted by Parliament. So we don't have a separate decarbonization goal, but emissions in our portfolio have marginally declined over this period. And that's interesting. One of the reasons for that is that we have divested from companies with high emissions. I'll get back to that. Next. Yep. So risk-based divestments. These are decisions, financial decisions, to sell companies that we believe have unsustainable business models. They add long-term risk to the fund, and we can sell them. They are not ethical exclusions, so they're different from the work of the Council on Ethics. They remain in the fund's benchmark, and so they contribute to the relative risk of the fund, and they're financially motivated. In last year, we did 49 divestments. 10 of these were associated with climate and nature-related risks. When companies improve, we can bring them back in. We can reverse previous decisions. Many of the divestments we've made were made 10 years ago or more. And so last year we started reviewing many of those decisions, and we decided to reverse 16 of them. 8 of these were related to climate and nature-related risks. I mentioned that risk-based divestments are financial decisions. So like all our investment decisions, we track returns on a daily basis. This picture is quite positive and interesting. What we've seen is the cumulative effect of these decisions has increased the returns of the fund by 64 basis points, or more than 16 billion kroner. Climate-related divestments have made the biggest contribution, in part because they account for the largest share of divestments. Nature-related divestments have also contributed positively. So there's a story here. If we sell risky companies with unsustainable business models and reinvest in the broader market, we can generate a positive return. That's at least the experience from the last 10 years. But as we can see, these returns are volatile, so we don't know if they will continue to be positive in the future. Now, we measure climate risk using different methods. This is stated in our mandate, but it's also prudent. We don't believe a single metric tells the whole story. We need to look at a menu of different metrics to understand risk in the fund. Scenario analysis is a tool for understanding how different climate scenarios might impact the fund over time. So this is an important part of our toolkit. We have used a bottom-up approach for the last 4 years. This is where we started with this work. It basically means you estimate the net losses of climate change at company level, and then you aggregate that up to portfolio level. We've looked at a range of climate scenarios, including scenarios with very high levels of warming. The results show estimated portfolio losses between 2 and 10%. It's quite modest if you think about these include scenarios with very high warming. So we have identified a number of weaknesses with the bottom-up approach that we talk about extensively in the report. To further develop this work, we've developed some internal top-down approaches. The first one looks, and this is the starting point here, is the macroeconomy. So it doesn't start with companies, it starts with the macroeconomy and the GDP effects of climate. This exercise yielded 19% loss for US equities under a current policy scenario. So it's a fairly moderate warming. So if we looked at a more extreme warming scenario, we might have even higher losses. In addition, we started looking at how nature risk could be included in these scenario models. As Mia said, currently this is a very nascent field under development. So we worked with a set of academics at the University of Minnesota and looked at what the effect on global GDP would be if 3 ecosystem services collapsed. These are 3 out of total 18 ecosystem services. It doesn't capture all of nature risk, but it's a portion of it. And the result was roughly 2% GDP loss. So what can we learn from all of this? Well, we can see that the results across these different models vary. And we know why, because they measure different things, they have different assumptions, different inputs, different scenarios. We also know that they're in their early stages. They're continuously developed. And this is good, but it does mean that you cannot compare results over time. They also don't say much about the pricing of climate risk in the market. And this is critical information for making investment decisions. So for that reason, we're not using the results directly to make decisions, but more as a way to understand broader portfolio risk and how to use different models to better account for that. Right. Alexis, maybe you can talk us through how we work with these issues as an active owner.
Thank you, Christopher. Companies are really the core of our approach, how we manage climate risk, because in our Climate Action Plan 2025 that lays out our strategy to address climate risks, we state basically that engaging with the highest emitters in our portfolio is the core of our strategy. And since our portfolio broadly represents the market, our climate risk exposure mirrors market-wide risks channeled through these companies. So ultimately, how these companies address and manage the risks determines our portfolio risk exposure. In 2024, we engaged 519 companies on climate and nature issues. We conducted 141 net zero dialogues. These are in-depth, often multi-year-long dialogues about companies' climate targets, transition plans, and emission reductions. And we set 753 specific objectives for these dialogues based on companies' plans and progress versus peers. And as you can imagine, doing this effectively requires robust quantitative and analytical foundations to determine which companies should we engage with, which issues to prioritize, and how do we measure progress over time. And the starting point for our work are our public expectation documents on how we want our portfolio companies to manage sustainability risks. They are financially motivated. This is about ensuring that risks are well managed and businesses create value over time. What's new? In 2024, we took the important step to quantify all our expectations in quantifiable scores, creating a powerful tool for us to measure to what extent companies actually fulfill our expectations. And these scores, behind them lies a sophisticated methodology. We combine multiple data sources, we use AI to extract further data points, and we apply machine learning techniques to fill data gaps. We will continue to seek ways to improve these scores further. How are companies performing in 2024? These numbers tell an interesting story. Climate scores average 56%, meaning the average company in our portfolio meets over half of our expectations, and we are seeing constant improvement over the last years. Biodiversity lags behind, standing at 32%, but with a faster growth rate than on climate, suggesting companies are waking to nature risks. The biodiversity gap, you could say, is most pronounced in risk management and target setting aspects. Few companies have actually concrete biodiversity goals. And for climate, the blind spot really remains a lack of transparency by companies on how they engage with regulators and policymakers. And Julia will explore this issue towards the end of the presentation. Now, we talk a lot about management practices and disclosures, but the question is, how does that actually affect corporate performance? We don't have good sustainability performance indicators for many topics, but we have a good starting point when it comes to climate. Companies Scope 1 and 2 emissions. And the graph you can see here shows you actually how the companies do on our focus list. That's the list where the highest emitters are on, we have in our portfolio. And here we cluster them by the 23 scoring on our climate expectation scores. So the black line here shows you the companies meeting at least 75% of our expectations. They had declining emissions since the Paris Agreement, since 2015. And now the companies scoring worst on our climate score, you can see that actually emissions went up since our starting point here we have in 2015. That's reassuring. We're capturing something meaningful. These correlations give us some confidence, actually, that when we address companies' management and disclosure practices, that likely affects corporate performance over time. Key indicator when it comes to companies' management of climate risks are whether they have robust net zero targets. This graph here shows you the development, how much of our finance emissions are covered by net zero targets, and we reached 74% last year. So theoretically, these emissions, they're all managed, addressed by the companies and should decline to net zero by 2050. While encouraging, you may have seen in the news over the last months, there are companies pushing out targets or canceling net zero targets. So whether the future progress is more uncertain than this positive trajectory I've seen over the last years. Scrutiny of targets is also increasing. Last year, the Science Based Targets Initiative, that's the main body in a way to evaluate and approve corporate net zero targets, removed at least 87 companies because they didn't submit their net zero targets in time. That gives us actually a good setting to analyze how do these targets, how they're valued by financial markets. So here with this research piece, we're looking at the stock market reaction to these companies not being chucked out by SBTi. And we can see in developed markets, we see a statistically significant negative share price reaction of over 2% when companies, around the event when companies lost their target. In emerging markets, that's not statistically significant. And obviously, we need to remember this is an event study, right? We have a small sample. But still, I think it suggests that in developed countries, really financial markets take that into account and react to a company losing approval of its target. And that could be either because the market is concerned about the company's management of climate issues, or it can be seen more broadly as an indicator of poor corporate management quality if you kind of suggest and commit, but then you can't follow through and set and get a target approved. Now, this completes the chain I wanted to lay out from management quality to sustainability performance here, emissions, to actually how financial markets react to changes in management indicators. It's piecemeal, but I think that's how we need to break down the problem of how sustainability factors affect asset prices. We also believe that supporting academic research is very important, specifically now that the financial implications of climate and nature risks become more apparent. This is really not the time to say we know enough. And we have recently funded 3 new projects with the National Bureau of Economic Research, with NYU, and with Imperial College in London. And we have entered a research collaboration with the University of Zurich on this survey I mentioned in my introductory remarks. And I want to share a few more insights from this survey conducted with Professor Sautner and Wagner and my colleague Snorri Gjerde here at the fund. We sent out the survey in February, so the data is brand new. We had over 300 companies responding on their perceptions of nature risk. And I want to share a few key figures from this survey with you. Already today, 44% of the responding companies believe physical nature risks has a financially material effect on their companies, while 28% believe the same is true as for transition risk. And just to remind ourselves, physical risk here refers to the direct impacts of nature degradation, whereas transition risk is more about regulatory changes, policy changes, and shifts in consumer preferences as we move to more sustainable economies. For context, there was a survey carried out in 2019 on investor preferences, actually perceptions of climate risk. And it showed nearly the opposite results, where 55% of the investors actually felt that transition risk was already material, whereas only 34% said the same about physical risk. These findings, they suggest two key observations. And again, acknowledging we are comparing surveys from different points in time and different respondents groups. First, physical risks appear more material relative to transition risks when it comes to nature, while the opposite holds true for climate. Second, that's probably an important finding, the level of risk awareness for nature seems comparable where we were when it came to risk awareness on climate 6 years ago. Julia, we're seeing rapid evolution of our assessment and knowledge and awareness of these risks. What are the key areas we still need to understand better?
Yes, thank you. While we have made progress with our combined disclosures, we still have a lot to learn about nature risk. All sectors in our portfolio depend on healthy ecosystems and water resources. We have identified several sectors that could potentially have very high impact on nature, including basic materials, food producers, and energy. In total, companies comprising 20% of net asset value could potentially have very high impact on nature. This assessment provides a useful overview, but it does not allow us to assess individual companies' risk exposures and guide our engagement with companies. Therefore, a more granular analysis is needed. Our goal will be to better understand which natural resources our companies rely on and how companies can impact this complex system. As Mia already mentioned, we also need to gain a better understanding of the links and trade-offs between nature and climate to fully understand the fund's risk exposures. This year, we have taken a first step to understand location-specific nature risk. This map shows asset locations of our tech companies in our portfolio and their exposure to water stress areas. You might notice, though, that these assets are clustered in certain regions. And one of the missing pieces here, we believe, is value chain data. And we need to understand not only how nature risk affects direct operations, but entire supply chains. And our next step will be to utilize open source geospatial data to understand these location-specific risks better, and to use AI to assess already publicly available data. For climate, we will focus on 3 key areas: climate performance, corporate policy engagement, and scenario analysis. It is key for us to understand companies' actual results versus their stated goals. And this leads us to another very important question on companies' actions. Do companies with net zero targets lobby against climate policies? We recently published a view on responsible corporate policy engagement. But we have actually raised this topic for nearly 20 years. And given our long-term interest and diversified investments, we now want to understand this better. We are utilizing an AI-driven approach, again, to uncover misalignments between public commitments and actual lobbying activities. As Christopher mentioned, we also will continue developing our scenario analysis for climate and nature. And we believe that this is crucial for understanding how physical risk will impact the fund in the future. So now I'm really looking forward to hearing perspectives from our panel on how to manage nature and climate risk going forward.
Please. Yeah, so we're really, really pleased to be joined by Nicola Ranger and Martin Skanke, 2 eminent panelists with a wealth of knowledge on this topic. So let me start with you, Martin. You authored a seminal report on climate risk and the fund.
Not me alone.
not you alone, with the Commission, but you were the face of it. And it was highly anticipated. It made a number of recommendations, and most of them were accepted by Parliament. This was 3 years ago. So now we feel like it's a very different time. So I want to start with you. What do you think has changed, and both in the world around us, relevant to climate risk, and how this should be managed by a financial investor?
Yes, thank you for having me. A lot has changed, actually. I went back to look at the report and thought about what would I have done differently now. And it's striking how much has changed in just 3 years, I think. On physical risk, I think the publication also of the 6th assessment report from the IPCC that came, I think, March 2023, gave us, I think, a richer, fuller picture of physical risks. And we might come back to this, but I think there are some structural, sort of methodological issues that have to do with how we've modeled this that has led us to significantly underestimate physical risks. And I just looked at the survey you did in 2019. I think it's fair to say that when we did this report, I think we also had sort of, not maybe explicitly, but implicitly there was an assumption that what matters in the very sort of near term, medium term is transition risk. Physical risks are really important, but they're sort of further out in the future. I think if I were to write this report today, I would have stressed that physical risks are actually very material and important also in the short and medium term. So I think we've actually underestimated the near-term effects of physical risk. So that's number one. On transition risks, I think the mindset then was that, I think inspired a lot by the NGFS, the Network for Greening of the Financial System, and their work categorizing, physical transition risk and orderly, disorderly transitions. So, as a former consultant, I love 2x2 matrices, so I was very inspired by that. I still think that framework or that way of categorizing makes sense, but in 2020 or 2021, I think we thought that there were several viable, orderly pathways to net zero. I don't think they exist anymore. And it's a little like, the famous opening line of Anna Karenina, which says, all happy families are the same, and unhappy families are all different. Because there's only one way to be happy, and you check all the boxes. And there are many, many ways of being unhappy. And I think in terms of transition risks, I think we're at the point where there aren't really many orderly pathways to net zero, maybe none. But there are many, many different ways a disorderly transition could play out. And I think what we don't understand is what are the relevant dimensions of disorderly. And I think investors need to think about what could disorderly look like. And I'm hoping, and I know that you, Norges Bank, is involved in work with updating the NGFS scenarios. I think, and now working partly in the private sector and chairing the risk committee of a large investor, I think we would be hoping for some more guidance on how we can think systematically about the different ways in which a transition can be disorderly. And I would have focused more on that, I think, if I were to write a report today.
So, Nicola, let me bring you in. So, Martin mentioned the underestimation of physical risk in the near term. And I also mentioned in my remarks that the models that we use and see tend to underestimate this risk. You've worked extensively with climate modeling, nature modeling, and also with a variety of participants in the financial industry, insurers, banks, central banks. So what is your current kind of assessment of the state of these models, and how are they used in the financial industry?
Well, thank you very much. And firstly, thank you for inviting me to be here, and also huge congratulations for this brilliant work that you've been doing. I really, really welcome it. And so to answer the question, firstly, I would say that most of the scenarios that we use, or financial institutions are using, are not representing the risk. So they're not representing what, say, the IPCC tells us are the key physical risks, and they're definitely not representing the link between climate and nature risks. And so what we see, so when we've interviewed financial institutions, for example, particularly banks and insurers that I mainly work with, we find that actually they know this as well. So they're looking at the scenarios and they're asking exactly the same questions that the scientists are asking, and knowing that there's something hugely missing in these scenarios. And for example, we did a survey after the Bank of England's stress test. So the Bank of England did its first climate stress test about 2 years ago, where they provided financial institutions a set of scenarios and asked them to run them and report back on the findings. And we did a big survey with the Bank of England afterwards of all the participating firms. And all of them said they did not believe these scenarios actually represented the risk. And these scenarios were based on the NGFS scenarios with a sort of tweak to represent the UK on top of that. So we know that they're underestimating the risk. But some specific areas, and I would say on transition risk as well, I totally agree with you, Martin, they're not picking up the disorderly transition scenarios that we see out of the window now. And they're also, I think, not picking up the fact that in reality, it's not going to be that we see transition risk or physical risk. We're now in a world where we're going to see these two things together and actually impacting many of the same sectors at the same time. But coming on to sort of specific things on the physical side that we see sort of in the research that we're doing. So I focus on a number of different aspects of it. So one is around extreme events. I also particularly focus on things like cascading and compounding risk, so how these different things play out, how they transmit across different countries. And some of the things that we can see is that, for example, the scenarios that are being used are not even really thinking about extreme events. So until actually the latest version of the version 5 of the NGFS scenarios, they were not capturing really any extreme events. Now they're doing a bit better, but they're still not capturing the types of events that we see, again, from looking out of the window. And I used to work in the insurance industry, that the insurance industry is very aware of. These are not captured in the types of scenarios that are being used by investors and banks at the moment. They're also not capturing these cascading risks. And what do I mean by that? So what we can see when a disaster hits, what are the big things that really affect the economy? So yes, there is the reconstruction of buildings and this sort of thing, and we pretty much are able to capture that now. But what we know is really causing the risk is things like power networks going down, interruption to water supplies, people not being able to get to work. All of these what we call these sort of network risks are not captured at the moment. And we know that actually a lot of the risk is coming from these types of things. So a lot of the work we do is to try to capture these added risks. And we know that this is going to at least double, if not more, the size of the risks. Coming on to the nature side, and again, I really appreciate the work that you're doing. Really, really great. And I know sort of we were just commenting the other day in the social media field that everyone's picking up on this work and really applauding it, and I certainly do as well. I think on the nature side, so I think this is it's the elephant in the room, and we wrote this paper with the NGFS called The Green Scorpion, which was our version of, this isn't the elephant in the room, it's the great green scorpion in the room that's going to sort of hit us. These risks are not taken into account, and they interplay. It's very, very difficult to separate climate and nature risks because they're fully interconnected. I'll give you a couple, actually, from some work that I'm doing with the World Bank at the moment. So I just picked out a few that I know are linked to your portfolio, or your geographical portfolio at least. So Brazil, for example. Some of the biggest risks in Brazil right now are how land conversion, so we all know about the Amazon, but the other areas like the Cerrado, for example, land conversion in the Cerrado, which is very much linked to mining, is putting huge impacts on aquifers and impacting on water availability across the whole country. And this is an enormous potential limit to growth. So it's that interplay between these nature-related factors, but also the climate, so the increased pressure from changes in weather conditions, but also what's happening in terms of economic development. And these things are coming together and they're amplifying each other. The other one I mentioned is Morocco. It's a really interesting one as well. So Morocco as well, big water constraint issues. So they have huge potential in terms of renewables, but they can't exploit that at the moment because they don't have the water to do it. So this is putting a constraint on their growth and is also impacting on their agricultural system. So this interplay between water, energy, land, nature is all coming together and amplifying. And again, we're not taking account of that at the moment. I think on the nature side, one of the big things that I've been particularly sort of pushing on is we often associate nature, when we think about nature risks, we think about the birds and bees and butterflies. That's not where the big risks are going to come from. Yeah, everyone loves birds and bees and butterflies. I do, but that's not what's going to get the economy, and it's not what's going to hit investors. And you know, the 2% number you quoted, you know, that's based on fisheries, timber, and pollinators. Again, like fisheries, timber, and pollinators are important, but for a small part of the food system. Timber, fisheries, again, really important in terms of local livelihoods, but for the whole macroeconomy, not big. So that's why you're seeing this tiny 2% number. If you took into account these big water supply issues, big soil quality issues impacting on our food system, you can very easily get into 10, 20% potential losses to GDP. So I think there's a lot of things. I think we're making a lot of progress. I don't want to sound too negative, but there's a lot of things that we just need to be aware that are missing at the moment.
So it sounds like from your summary is that we actually know quite a bit of this risk, and we also know that the models don't capture all of it. So what is the state of kind of pricing this risk in the market, which I said was a critical point? Like, what do you think, Martin? To what extent are investors factoring this in?
So I think some of these risks are at least understood. I think the transition risk on climate is relatively easy to model because you can model it essentially, at least the direct effects, as sort of increasing the price of CO2 emissions and see how it affects corporate profitability. And I think most companies are doing this. So that's not. I think capturing some of the indirect effects that's more challenging. Just to take an example from Norway. So you increase the price of CO2 emissions. That creates a lot of demand from oil companies for electricity to decarbonize their operations. But that increases the energy prices for other companies, including companies that have already electrified their production processes and have zero emissions. So even thinking about, you had this graph about financed emissions or emissions from the portfolio, it doesn't necessarily say a lot about risk, because there could be lots of transition risks, even for companies with zero emissions. Because I think, to use sort of economist speak, we're thinking too much of this as a partial equilibrium problem. But it is a general equilibrium problem. And we have market failure in very many markets that are a necessary integrated part of the transition. And so in terms of policy prescriptions, I think we have thought too much in terms of finding optimal policies. When we're faced with this enormous uncertainty, we should be thinking more about finding robust policies, no regret moves, and thinking more systematically about how can we make decisions that will minimize the expected regret in the future. So for climate policy, very, very simplified, you can make two mistakes. Right? One is you have a very strict climate policy, and it turns out, the climate issue wasn't so important after all. So that's one policy mistake. Or you could have a very lax, unambitious climate policy, and it turns out that, this was a really important big problem. Which policy mistake do you think you'll regret the most? Well, clearly you'll regret most having triggered irreversible climate change. The regret of having a too ambitious climate policy will be pretty small, because it simply means that you will have been speeding up maybe too fast a transition to low carbon technologies that have many other advantages anyway. And so I think this whole modeling, and economists love their models. And I think one of the problems of these models, particularly the so-called integrated assessment models, the models that combine sort of a climate model with a macroeconomic model, is that they are, by their nature, equilibrium models. They always search for an equilibrium. But an equilibrium model is not really a good way of understanding risk, because you're not interested in what happens at the equilibrium point. you're interested in what happens in the tail end of a probability distribution. Sorry. And that's not captured at all. So I think we need to move away from thinking about this in terms of optimizing policy and thinking more about robustness. And that goes even at the corporate level, thinking about how robust are your corporate strategies across a range of different scenarios and minimizing regression. I think that robustness way of thinking about robustness is a much better way of dealing with deep uncertainty that we have in this space.
Would like to thank first of all you two. Thanks a lot for your insights. And thank you for coming. And for further, info you would like to have, I can just, encourage you all to check our disclosures and have a read.
Yep.
Thank you.